It's a depression 2.0 as a wrecking ball crushes stocks. I'm your host, Steven Van Metre, and thanks for joining me today. And investors are starting to panic as stocks nosedive, leaving many wondering if we're headed to a recession or perhaps even a depression. Let's pick this story up when we head over to Bloomberg, where its headlines that history suggests that an oil shock raises the probability of a U.S. recession. When oil prices rise 50% above trend, a recession follows, according to Pickett Asset Management. In the past 50 years, every time, strong words, oil prices adjusted for inflation rose 50% above trend, a recession followed, according from data from Pickett Asset Management. And fear is already playing out in the stock market as stocks head lower as the war rekindled inflation concerns and clouded the outlook for corporate profits. Because, of course, war is inflationary. And even though that doesn't always make a lot of sense, what we do understand is that energy prices going higher squeeze budgets. And how this works into corporate profits is if people have less money to spend, corporations have less revenue and less profit, and that means stock prices go down. Let's continue on. I don't expect an economic disaster, but what we're seeing in oil prices will have a significant impact on growth, according to Pickett Asset Management. Well, I think they're wrong, because even in their own chart that they publish, they show that when oil prices surge above trend and they circled in red, there's this gray bar that signifies a recession. In fact, the only one they're missing is the one that we may be headed into right now. And as far as the equity market goes, you can see here when we take crude oil, it's shown in blue, against the Wilshire 5000, which is a total U.S. indice, in red, and you see when crude oil prices rise, you start to see stock prices peak and then head lower. And here you see going into the great financial crisis, oil prices rose and stock prices rolled over and headed lower. Start to sound familiar? And here you can see in 2015, as oil prices were headed higher, stock markets slowed down until oil prices came down. You see it happen again, and now people are saying, why isn't the stock market going up? Well, because usually during regimes of high oil, it tends to go down. Let's continue on. Because to be sure, oil price shocks have ended economic expansions, very obvious as I just showed you, like those in the mid-1970s and early 1980s and early 1990s. But other downturns weren't directly caused by a sharp rise in oil prices, like the 2001 recession and the global financial crisis. Well, let's talk about the global financial crisis for a moment, because what happened? Interest rates went up and people's adjustable rate mortgages went up and their payments went along with it, and they couldn't make the payments. But perhaps part of the catalyst for that was high energy prices and high inflation, and the consumers couldn't afford those higher payments, because if the economy was indeed booming and wages were rising fast enough, everybody could be able to afford it, and they didn't. And that's why you see that high energy prices are usually the final catalyst before we see an economy going into recession. Few economists say that the U.S. is in danger of recession. Well, of course. How many economists ever say we are? Since the economy is underpinned by a strong labor market, strong consumer spending, and better than expected corporate profits. Well, not for much longer, but many expect growth to slow further, and key words, growth to slow further if inflation continues to rise. The war in Ukraine has injected further volatility in the markets just as the Federal Reserve enters a rate hike cycle. Now, keep in mind, if you're wondering why bond prices aren't selling off rapidly here, and in fact they're holding up fairly well, it's because the slowing growth. Now, when the inflation part rolls over, then you'll see bond prices really shoot higher. But did someone mention volatility? Well, if you missed my 30-minute show, I think it was a couple Saturdays ago, on volatility and what happens when it gets out of control, you should watch it. But let's take a look at this chart, because when we talk about volatility, we start to get excited here, because I've got crude oil shown in blue, and when crude oil prices rise, you see volatility start to go up. And here you see going to the great financial crisis, crude oil prices shot up, volatility followed. And then you can see here, in the years following, crude oil rose, volatility rose, crude oil rose, volatility rose, and you see it again, and now volatility is about to spike, and you've already seen that leads to an unwind in the equity markets. So we already know what is coming, and this is why you're going to start seeing headlines just like this one the Wall Street Journal ran today, as Dow falls sharply after oil hits 130 a barrel. In fact, if you're concerned about how your portfolio is performing right now, and you should be, and you're looking for a strategy that reduces your risk to the downside, well, be sure to check out Portfolio Shield. Put a link in the corner in the description below. You'll be glad you did. All right, let's go on, because we see surging price of everything spells stagflation, risk, recession. And of course, Barclays and JP Morgan cut growth outlook, lift inflation view. And there we hear that cut growth, reduce growth. And what do bonds like? Well, they like lower growth and lower inflation. And that's why once this inflation story breaks, you can see bond prices go up, and that is how it always tends to work. Let's continue on. The question is whether economies will suffer stagflation or another recession just 2 years since the pandemic forced the deepest slump in decades. Well, there's no doubt, because what tends to follow periods of stagflation are recessions. That's exactly what you get. You get deflation. And why is that? The reason we don't have prolonged periods of stagflation is because people cannot afford higher prices. And that's, if they had some ability to afford a reasonable percentage of the increase, then we could see a period of stagflation. But in this case, in fact, in cases in the past, wages are not keeping up with inflation. And then you start to see stock market comes down. And so people who are retired and living off their investments, they start to panic because they're seeing their wealth evaporate, and they cut their spending. And that's how you go from stagflation into deflation. And that's why we always tend to see that. And the bond market, finally a headline that makes sense. The bond market sees a recession in the oil shock. The message from the drop in yields is the economy isn't strong enough to withstand the record jump in prices for energy and other commodities. And yes, it's so obvious that that is true. And finally, we get some truth, but hang on. Because whenever oil prices shoot higher, there's a debate among economists, and there shouldn't be, because I've shown you about whether it will spark faster inflation or act as a drag on economic growth. Now, why isn't it spark higher inflation? Because if people can't afford those higher energy prices, then it leads to a drag on economic growth. And you have to look at what is driving, of course, the rise in energy prices. Is it because wages are rising so quickly that people are out spending money? Or is it right, or energy prices rising for other reasons and wages are lagging behind? And we've already looked at this in past shows, how wages are not keeping pace. So why economists would be confused by this is beyond me. There's no definitive answer, because it all depends on the economic backdrop at the time when crude is rising. Yes, are wages rising as fast? And the answer is generally no. So while inflation expectations as measured by the U.S. bond market over the next 5 years rose to the highest since at least 2002, again, keep in mind when we talk about treasury yields, when you see inflation expectations peaking, where are they going to likely head next? That's down. And of course, if we already know growth is falling, well, you can already tell that where yields are headed lower and bond prices higher. So longer-term treasury bond yields fell, although not today. They are now starting to trend lower, although the key benchmark yield curves contracted significantly, with a very important gap between the 2 and 10-year treasury yields narrowing to the least since March 2020 at the very beginning of the pandemic. This market response does not scream inflation. It doesn't. Exactly. It screams the opposite, which is deflation. And here you can see what crude oil's impact on the bond market. See, everyone gets it wrong. You see rising crude oil, lower bond yields, rising crude, lower bonds. And these are 30-year yields shown in red. You see crude peaking, yields going down, crude up, yields down, crude up, yields down. And what is that telling you? It's simply telling you that financial conditions are tightening, and that's what crude oil is telling you, that the economy can't handle it, and the response by the bond market isn't higher yields, it's lower yields, because it's trying to take some pressure off. And why does it take pressure off? Because what do people do when interest rates go down? They borrow money, they create money. So the monetary system, our financial system, is trying to ease these tight financial conditions created by oil, and that's why you see interest rates go down, and why the market always has it wrong. Check it out. Again, here you see 2018 oil up, yields down. Now you see oil up, and everyone thinks yields are going up, but history here looks pretty good about the direction yields are headed. In fact, if the market doesn't get itself under control here, if history has any indication of what's coming, we're heading into a recession at the time the Fed is tightening, and that's why the headline says recession to depression 2.0, because that's the likely direction we're headed. And with that, I'm Steve Van Metre. Thanks for joining me today. I appreciate you being a fan. Appreciate you watching. Bye now. Content of this video is private educational informational. Is not intended to provide investor advice. You're not to be construed as recognition or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity. Business expressed this video that do not reflect the valid advising or Steven Van Metre Financial.